Lesson 1. Introduction to Money. The definition of money. Money is anything that is commonly accepted as payment for goods and services, as well as debt repayment in a certain socio-economic environment or nation. Money may be classified into three types: commodity money, fiat money, and fiduciary money. Many commodities, including naturally rare precious metals, conch shells, barley beads, and other valuable goods, have traditionally been employed as commodity money. The value of commodity money is determined by the commodity from which it is derived. Money is made up of commodities, and commodities are made up of money. Fiat money is money that has no intrinsic worth or assurance that it may be turned into a valued product, such as gold. Instead, it only has value because of government decree, fiat. Typically, the government proclaims fiat money to be legal tender, making it illegal to refuse to accept the fiat currency as payment for all debts. Fiat money is represented by paper money. Bank demand deposits, such as checking accounts, are examples of fiduciary money. Fiduciary money is accepted because its issuer, the bank, commands trust. Fiat money is the foundation of the majority of current monetary systems. For the majority of history, however, practically all money was commodity money, such as gold and silver coins. Functions of money. Money serves three fundamental purposes. It serves as a medium of exchange, a unit of account, and a store of value. 1. Medium of exchange. Money serves as a medium of exchange when it's utilized to facilitate the exchange of commodities and services. 2. Unit of account. It is a common numerical unit for measuring the market worth of commodities, services, and other transactions. It is a relative worth and postponed payment norm, and, as such, is a necessary precondition for the development of commercial debt agreements. To be countable as a unit of account, money must be divisible into smaller parts without losing value. Fungible, one unit or piece must be viewed as comparable to any other, and of a specific weight or size. 3. Store of value. Money must be consistently saved, kept, and retrieved in order to serve as a store of value. When recovered, it must be useful as a means of trade, in a predictable manner. Furthermore, the value of money must stay consistent throughout time. Economists occasionally mention extra purposes of money, such as a standard of postponed payment and a measure of value. A standard of delayed payment is an appropriate method of settling debt, a unit of measurement in which debts are designated. Money's position as legal currency implies that it can be used to pay off obligations. Money may also serve as a standard measure and a typical form of trade denomination. As a result, it serves as a basis for quoting and negotiation pricing. Its primary application is as a tool for comparing the values of distinct items. Did you know that the U.S. government once printed the largest banknote ever started from December 1934 to January 1935? It was the $100,000 gold certificate, which was only utilized in transactions between Federal Reserve banks and the U.S. Treasury. Reader's Digest, Spectre B, June 6, 2022. Types of money. There have been different types of money throughout history, ranging from seashells and spices to banknotes and debit cards. At the moment, fiat money is the currency in use. 1. Fiat money. Examples: banknotes, paper money, and coins. Fiat money, fiat currency, is money whose value is established by the governing authority's official decision, fiat, rather than its inherent worth. The government declares it legitimate money, and it must then be accepted as payment everywhere. A partially damaged banknote can be replaced by the Federal Reserve Bank since it lacks inherent value. Money as a commodity, on the other hand, cannot be. 2. Commodity money. Examples: precious metals, i.e. gold, salt, beads, alcohol. Commodity money, unlike fiat currency, has inherent value. It gets its value from the thing from which it is made. If money is destroyed, it cannot be replaced. It is also the oldest type of money. These commodities function as a medium of exchange and gain value owing to scarcity. The usage of this sort of money is analogous to the barter system, in which products and services are exchanged for similar commodities and services. In contrast to the barter system, commodity money serves as a unit of account that allows you to compare the value of commodities and services. 3. Representative money. Examples: certificates, paper money, token coins. Representative money, like fiat money, has no intrinsic value. It is backed by a commodity, as opposed to fiat money. As a commodity-backed currency, it may be traded for precious metals, such as gold, stored in a bank vault. It was simpler to transport a certificate than a chest full of riches. 4. Fiduciary money. Examples: checks, bank drafts. Fiduciary money, derived from the Latin word fiducia, which means trust, is based on the issuer's assurance and trust that it will be exchanged for fiat or commodity money, bank. People are not compelled to accept it as payment because it's not government-issued legal money. 5. Commercial bank money. Example: funds in a checking account. A claim against a bank for the purchase of goods and services is known as commercial money, also known as demand deposits, through the means of withdrawing in person, check, ATMs, or online banking. It is a bank-created debt money. They make extra money by using a technique known as fractional reserve banking. Only a portion of the money that the bank has is stored in this account. The remaining 10% is distributed to others in the form of loans, with the bank profiting from the interest and fees charged to clients. In summary, the bank lends the money you deposit to others in order to produce additional money through interest.